Want to buy a property soon but don't have your deposit fully saved? Well, here's what I did to buy my first home. If you're looking to buy a property soon, you've probably been doing some home loan research. And within that research, you've probably stumbled across guarantor loans. Well, what are they? How do they work? And are they right for you? Let's have a look. Disclaimer, I think guarantor loans are great. Like I said, I have used one myself to get into the property market many years ago. And my prediction is that guarantor loans will actually have a rise in popularity as the housing market continues to outpace first home buyers' ability to save for a deposit. I think the government is doing a decent job at providing alternatives like the first home guarantee scheme, but I think that the guarantor loan will, for the right situation, be a good alternative. It'll be just another weapon in the arsenal, a sandwich in the picnic basket, if you will. A guarantor loan gives you the ability to borrow 100% of the money required to purchase a property. So that is the purchase price and any costs associated with it, eliminating the need to have a deposit saved. As a disclaimer, if you have absolutely nothing saved, then I would not recommend getting a guarantor loan, or I would not recommend any other sort of loan for that matter. But if you have started saving, you just don't have the full deposit, then a guarantor loan could be a good option. Because you will be borrowing 100% of the property value, your servicing does need to be quite strong. So you need to be able to borrow the full amount. So how does it work? A guarantor loan lets a close family member use the equity in their property to secure your deposit. So the ideal size deposit when you buy a house is 20%. This avoids any mortgage insurance costs. So we use mum and dad's property for the 20%, and then the other 80% is secured by the house you're buying. Now, we don't actually take the 20% out of mum and dad's property. We just tell the bank, hey, look, mum and dad have this property over here. It's going to secure the 20%, and the new property we're looking at buying is going to secure the other 80%. So the main benefit is that you can borrow 100% of the costs involved. So you don't actually need to have a deposit saved. And you also now don't have to pay any mortgage insurance because you have a 20% deposit. And you'll have access to the best interest rates available. Now, obviously, there are some things to keep in mind in this scenario. Whoever goes guarantor for you will need to know that if you fail to make your repayments, then they will be responsible for that 20% that they guaranteed. This is why I recommend when setting up a guarantor loan that you transfer any deposit that you have managed to save over to your guarantor for them to hold. This way, if you can't make your repayments for whatever reason, say you injure yourself at work, the guarantor has some money set aside so they can make repayments in the meantime. A couple of other things to keep in mind: there will be some implications if the guarantor wants to sell their property, and their borrowing power will be affected a little bit because now they essentially have a little bit of debt against their name. So you want to make sure whoever's going guarantor for you isn't planning on making any big changes in the near future. On that note, how long does mum and dad then need to stay guarantor for you? Well, it's usually until your loan is at 80% of the value of the house. So say you buy a house for $700,000. Guarantor loan means you can borrow 100% of the costs. So 700 plus a few extra costs. So let's call it $710,000. Over the next couple of years, your loan will reduce in size and your property will most likely go up in price. So let's say in 3 years, your house is now worth $800,000 and you've managed to throw a little bit extra onto your home loan and you've got it paid down to $640,000. 80% of $800,000 is $640. So you've just reached the threshold where you can now refinance the loan and avoid any mortgage insurance costs. Now you can remove the guarantor earlier than this. It just means that you might have to pay some mortgage insurance. So the bank does have a few checks in places. They will check that the guarantor is in a good position to be able to be a good fit for this scenario. The guarantor will also need to seek independent legal advice to make sure that they aren't being pressured into this. And with some good what-if conversations between yourself and the guarantor, the facility can be set up with a bit of confidence. Now, obviously, this isn't a scenario that's available for everyone. Not everyone's in a position to have a guarantor, but for those that do, I think it's a really great way for a guarantor to be able to pass on some of that equity they've built up over the past couple of decades, perhaps. And it's just a way to share that wealth with the next generation without actually giving them any money. So I hope they increase in popularity, and I hope that the conversation around guarantor loans becomes more normal. I'd hate to see all this equity just sitting stagnant in all these houses that have gone up in value, and the next generation of home buyers can't come in and access any of that wealth.